Hey, market insiders, let's go down the rabbit hole a little bit on interest rates. This video is going to be for those who want to go deeper into this and get a glimpse at some real technical things. But I think that this is sort of that next level of trying to understand what's going on and being aware of major shifts in the market, right? And so if you don't have any desire to go deep and to look at stuff like you're seeing on the screen, skip the video. It doesn't hurt my feelings at all. But I know that there is a group of us that likes to go and get a little technical. And so this is for them. So I'm going to start by looking at the 10-year treasury. This is what mortgage rates are based on. So as this goes up, mortgage rates go up. As it goes down, mortgage rates go down. And the reason why is because you typically see the average time that you're holding a mortgage is about 10 years, right? That's why we look at the 10-year treasury. And this is essentially risk-free, meaning you're loaning the government some money. They're going to pay you 4% every year for 10 years if you buy a 10-year bond from them. It's risk-free because at the end of the day, they can just print the money. That's why you see mortgages coming in and having a rate more like 6%. There's usually about a 2% buffer on top of this risk-free interest rate that makes up mortgage rates. And that's because an individual person can go bankrupt. They can lose their jobs. They can stop paying their mortgage. And so there's risk involved in loaning a single person that money. That is why the interest rate is higher. And so I want to start off with this view. All this is interest rates over time. And then you're going to see all these lines. And they've color coded this to where green just means that rates are rising and red means that rates are falling in general. And it helps to visually just see how significant of an up or a downtrend there is. So we basically were going up until about May, when we started to see interest rates roll over, right? And so you can see here, it cuts into all the green. It actually gets to the bottom of the green, bounces back a little bit, but it does not go as high as it did previously. And that is a sign that mortgage rates would continue to fall, and fall they did, right? And so we know that there were all these expectations built in around mortgage rates coming down simply because the Fed was supposed to cut. And you can see the lines kind of spread out a little bit, fan out. But now look where we are. We have gone back up, and we've actually gone over this main moving average, which is what this is. And this is a very structural thing, right? Think about it right back here. This is the inverse, right? We went down, we bounced a little bit, and then we continue to go down. In this case, the market is digesting the fact that they may not get as many rate cuts as they thought, and it went up. And now the question is, what do we expect? What do we think will happen, right? And this is important for a variety of reasons. One, for yourself, just being aware that we may start to see a trend higher in mortgage rates based on seeing this helps you to communicate some urgency to your clients, helps you to allow them to understand that the market is changing and that people that were waiting for even lower rates may not get that. It helps you in your own business. I know me personally, I did a refinance and I locked in my interest rate right around here because I'm paying attention to this stuff. Right now, it looks like a really, really good decision. We'll see. But this is what I pay attention to every day and is an easy way to look at it. The cool thing, though, is if we back up and get a little more history, we can see just these trends, right? We had this big downswing, mortgage rates came up, they bounced back down, but then they continued this uptrend, right? I wouldn't be shocked as we look at this to see we've gone up a lot. This could arguably be overreaction. And then we come back down, people get excited. Oh my God, okay, rates are going to go back down again. But then we continue higher, just like we saw here. That's sort of how you would look at history and use that to see what might be coming next. But the other thing that I like about this view is it really helps us to see these major structural trends that are happening. You can just see these ebbs and flows that are happening. And if I zoom out even further, I want to give you context on where rates are, right? Here is the move since 2020, right? This is where rates fell so much. We have been in a really strong uptrend until recently. The other thing that could be happening here is we could be just resuming this uptrend. There's a lot of different ways that you could look at this. I also kind of see, just to draw some lines on here to help us, potentially this sort of a trend happening, right? We may just be in a bounce back and continue down. It's all conjecture at this point, but once you see this, you realize, well, we were sort of really going up, and this could have been a bit of an overcorrection, and now we're resuming where we were. Let's look at one other way to look at it. This is, again, complicated, but once we make sense of it, it's not too bad. Let me move this out of our way. So I have highlighted major important interest rates, right? It's essentially on 0.8% in many of these cases. And what you'll find is that it's common that rates would gravitate towards these major points on this, and then either bounce off of them, or, they become major points in the market, right? So we bounced off 3.625. Now we're up to 4. 4 is a really big deal. You can see here we went up to 4, and then it was something that the market basically reacted against. They call that resistance. And so this is a big deal, though, because you can see we had this trend that I had been calling out before. And now the question is, that's a pretty significant break out of it. And are we headed higher? One of the other things that you can see down here, this is a tool that helps me to see when we sort of have overcorrected, right? When expectations have gotten too far ahead of themselves. And I've gone back in time and added these horizontal lines to let me know when we're at extremes. And they can help us spot tops and bottoms. In fact, you can look at this and see when this kind of goes outside this, the odds of continuing lower are really, really low. The odds of us seeing rates move higher is now where I'm focused on, and vice versa. Here we got a little ahead of ourselves, and we're very high on rates, and rates were more likely to come down. And so this helps me to see the probability of whether we'll see higher rates or lower rates. And so right here, this is what I was looking at when I was doing my refinance. I said, look, I think we're as good as we're going to get from what I can tell. I want to go ahead and lock in and take what I can get right now. There's no guarantees that this isn't the bottom. I don't also know that it isn't going to get better after this, but you can see what's happening. It's coming back, but we are still very, very low when it comes to where rates are today. And this tells me we have a lot more room for rates to go higher than we do typically for rates to go lower. And so when you put all this together, again, this is what I'm paying attention to. It's hard from a realtor standpoint because you're not going to necessarily bring this up to a client, but it can help you to know when to push on opportunities, when to encourage people that, I really do think rates are in a really good spot. And ideally mortgage bankers are looking at this, but I really don't think they are. I don't think they're trained to do this, because I know I wasn't trained to do this. This is something that I've, gone down on my own to learn. But I wanted to give you a little view into what I'm looking at and to why I think, and we'll talk about this more, I think we are starting the next leg up in interest rates. And that is going to be an interesting sort of situation, because there's probably a lot of people here that saw it, thought it was good, wanted to get better. And now this is also why I'm saying don't stress. I'd go ahead and take what you can get, because we may absolutely see this go back to 4.25, 4.5, and rates can get even worse than where they are now. And people will look back and go, yep, rates were better back then. I should have locked it in, even though I was waiting for them to come back down. So let me know if you have any questions. Hopefully this is interesting to you, and I will be happy to go in depth as much as you guys want.